Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. We've had him on before. We had him on actually, I think, early in 2014. He's known throughout the financial community for putting out an extensive year in review and also a preview of the next year. He's David B. Collum, Betty R. Miller Professor of Chemistry and Chemical Biology from Cornell University. He's also followed the markets extensively for years, and I guess he's a libertarian and a fan of the Austrian School of Economics. Thank you for coming back on, Dave.
Yeah, you're welcome. It's my pleasure. And your description of me was pretty accurate, probably.
Now, Dave, I want to talk about 2014 before we talk about where you see 2015. We've had a lot of interesting things happen in 2014. You mentioned some surprises before we started recording, but first I want to talk about some of these experts, what they predicted in 2014. I think one of the main predictions that a lot of these experts, and I'll say that in quotes, were predicting was that interest rates have to rise. What's your opinion on this? Because clearly, we've seen in the developed world, whether that's Japan or Europe or the United States, interest rates just keep going lower and lower due to, market intervention and financial repression and things like this.
Yeah, well, first of all, my opinion on experts. It turns out my training in chemistry helps me with this. I work in an area that it's very complex, and when I entered it everyone thought they kind of had a beat on it, and over the years it's turned out that almost nothing is held up to what I'd call experimental scrutiny, and so people's opinions are sort of worth what you pay for them. The experts are taking the most complicated system we could both imagine and somehow divining from that the belief that they can predict something. And a great example of the failure was the notion that when the Feds would start to taper, that the bond market would get crushed or at least be hurt by that. And I can't imagine a trade that was perceived to be more guaranteed than short treasuries at will. And of course the taper occurred. Best I can tell, it's a much more complicated phenomenon than just the U.S. There's money coming in from all the central banks, so it's hard to say what actually tapered. But the taper, the U.S.-centric taper, occurred, and bond prices went up, and interest rates went down, and everyone sat back in stunned silence, trying to figure out what just happened. So experts can get it way wrong, and so.
Yeah, I don't think the experts, and I don't hear this talked about on CNBC or Bloomberg once, is, all these, looking at the global economy comprehensively, like you mentioned. So China, Japan, they've printed enormous amounts of money. I mean, you and me probably weren't surprised that Japan printed enormous amounts of money more because there's no more demand for Japanese government bonds really in their private sector, and they have to keep selling more and more bonds. So, of course, they're going to have to print more yen to buy them up, and then that money is going to go into the hands of once that the bonds are bought up, there's going to be excess yen and there's going to be yen carry trades and things like that. But the people who are making these predictions, they're so mainstream. They see one thing the Fed does, and they to use a science term, and obviously, you try to do an experiment in a vacuum, right? But that's not how the financial markets work. The financial markets were in a very complex global financial market system where there's a lot of plumbing, things can leak in. There's no vacuum here where, if the Fed does tapering, the U.S. markets are closed off to foreign flight capital or foreign quantitative easing or anything like that coming in from China or Japan or anywhere.
Yeah, well, it's also like looking up at the sky and taking a pinpoint reading on the weather and then predicting what it'll be 4 days from now. A good overview, right? The Doppler radar on the weather can help you, but the fact of the matter is predicting the weather is about as accurate as predicting the economy, and they're trying to predict it a year out, so I don't think they're going to get it right. I don't think they can possibly see the unexpected coming, because then it wouldn't be unexpected. So I think some suffer arrogance. I think when people get it right, some people seem to get it reproducibly right, but this was dealt with in one of those neuropsych books. I can't remember the title. I was trying to think of it, where they talk about, this was Fooled by Randomness, where you practically take a sample size of 1,000 experts and then have them make 5 predictions, and they could have an 80% error rate and still out of those 1,000 experts, even with an on average 80% error rate, you'll have a small handful who will go 5 for 5. they'll be declared the smart guys and the geniuses in the room. And the fact of the matter is in a normal bell curve, you will get some people who can flip that coin 5 in a row or 10 in a row or whatever, and get the answer right. So the experts predicting this, I actually don't read those anymore very often. I will read the reasoning sometimes. The reasoning makes sense. I find that entertaining. But the outcome, the guys are saying, that we think the S&P is going to hit 2,300. Those guys are either delusional or lying. I don't know which.
Yeah, that's very interesting. I mean, the mainstream media, it's just kind of ridiculous. I think a lot of these guys, they know the producer or something like that, or they hired a marketing PR firm and they just pay to get on. And one thing that CNBC or Bloomberg don't really talk about that much is a lot of the track records of these guys. I mean, maybe they go after Peter Schiff and they talk about, your gold prediction or things like that. But a lot of these other guys, they don't bring up their track records normally, and they let them on all the time, especially if they're more, conventional thinking, mainstream Keynesians and stuff like that. They seem to get a lot of pass. Everyone else thought this, everyone on Wall Street thought this. It's okay. No one saw this coming.
Yeah, well, the other thing is that there's almost inverse correlation because someone who is prudent would probably be stepping out of the way, and therefore they wouldn't have the gains that the CNBC wants to see. And so if they go get some guy who's racked up 20% a year for the last 5 years, I'll show you a person who jumped without a parachute. And I remember years ago when Harvard was racking up huge returns, and I said to colleagues, I said, look, this is not an endowment, this is a hedge fund, and they've been crushed. They got crushed, and really seriously crushed. And now what's interesting is the endowments and the pension plans that are what you call the conservative kinds have done very poorly over the last 5 years. And people rant about how they're just stupid and they sold at the bottom and blah blah blah, and you hear the scorn in their voices. But here's what happened. So by the middle of 2009, it's clear that all the pension funds and all the endowments that they should have been acting responsibly and investing conservatively just lost a ton of money. And someone steps in, and what are they going to say to them? Are they going to say, well, now that you've lost a ton, you have to double down and get even riskier? No, they're going to say, look, dude, you just blew it. That's not how you manage money. You got to go 60-40. You got to go generic because you are not a hedge fund. You're a pension fund. You're an endowment. And therefore, they have underperformed on the way up because the returns in the last 5 years have gone to the cowboys. They've gone to the characters who are willing to risk someone's money to become famous and rich.
Yeah, a lot of these endowments and pension funds, Dave, they put an enormous amount of money into different hedge funds, and for a while I think you said it worked. But, when it doesn't work, a lot of these guys are not really hedged.
No, they're not at all. And the ones who are hedged did poorly over the last couple of years because they hedged, right? No, if you're a real hedge fund, you shouldn't have done that well over the last few years. You should have sort of viewed the risk as risk and not just, risk is not a synonym for return. It's risk. That's all it is. It's affiliated sometimes with return. But, so the guys who were trying to hedge risk would not have gotten the returns that some of the others got. So.
Yeah, that's true. So, Jim Chanos, who's more of a short, and he's more of a hedge fund, and then John Hussman, who's more bear. These guys, have not performed that well because the general indices, the general stock markets have continued to go up, up, up. And I'm sure, they're being called names and stupid, and people have redeemed money from their funds and things like that. But it is what it is. So when I don't think trees can grow all the way to the sky, just like Jim Rogers said. Now, I want to switch. You talk in your 2015 preview about some of the things that surprised you in 2014. Please tell our listeners some of the major things that surprised you the most.
Oh, what surprised me? First of all, everything is pretty calm. There were a lot of things that didn't surprise me. So, the muni market was very quiet, and that could have blown up, on a dime. I would say that 2014, as I described it, was more a year of risks than actual events. And so I think they were existential risks. They were huge risks. They were the kind that that can cause serious damage. And it's not to say they did. Of course, they did not, many of them, but that's not what risk is. Risk is not about what happens. It's about what could happen and what the consequences of that are. And so, we had events like Putin, which is still playing out, of course, right? The Russian story is just warming up. We had Ebola, which ironically I thought had gone into quiescence, but a case just showed up in Scotland, a case just showed up in Japan, and so just heaven only knows, maybe that thing will come back with some sort of renaissance next year. It's hard to say. But the fact that something doesn't happen doesn't mean it wasn't risk, right? You play Russian roulette, you have a 5-to-1 odds of winning. That's not to say it's not enormous risk. And so if you play Russian roulette and you win, you cackle because you say, oh, look, that wasn't risk. I didn't blow my head off. You say, yeah, it was exactly the same risk as I calculated. It's just that it didn't pan out. Once in a great while, risk pans out. The metaphor, the example I give, I finish when I'm trying to drive the point home is, in 1930s Germany, there were Jews who sat around the dinner table, talking about risk. And I'm aware that many probably couldn't get out of Germany, but certainly some families decided whether to mitigate risk and others decided not to. And the ones who chose to accept the risk and hope the whole thing blew over, they died. And so once in a while, risk turns into serious calamity. And to look at the instances where it doesn't and use that as evidence of why you should not mitigate risk is just silliness. But, as markets get higher and higher, the willingness to take unmitigated risk, unhedged risk, just goes up until finally you reach that fateful moment when everyone thinks it's safe. At the very instant that it's not safe, right? It's least safe. At the pinnacle of the market, people will think it's maximally safe when in fact it's about to kill you.
So are you reminded then just the sentiment that you see out of the mainstream? Does it seem like things are like 2007? Because the majority of the mainstream people on Wall Street, CNBC, Bloomberg, a lot of them didn't see the housing bubble collapsing in 2007 and everything, the excrement hitting the fan then. It just seems that the happy-go-lucky crowd, is back. The main consensus now for 2014, if I could sum it up maybe in a couple sentences, is that there is no inflation, unemployment is low, the economy is recovering, the U.S. dollar is strong, the U.S. economy is in a much better shape than anywhere else, and most of the people who are managing money, who are on Wall Street, they seem to believe that these types of trends, that they can extrapolate these things, linearly out for at least a number of years, and that the trends are going to hold for a while.
Yeah, I think they're probably a little warier than they were in 2007. I think 2007, 2007 was characterized by thousands of people seeing a calamity coming, but billions of people did not. And so in a voting machine, that means the billions won out, and you can say no one saw it coming. But I was reading about subprime risk back as early as 2001, 2002, when it was risk perceived only by a few, and you say, well, they were wrong. No, they weren't wrong. There was risk. It's just it got riskier and then eventually blew up. But I actually wrote a 5-page email to a friend of mine in 2002 in which I described the subprime risk and said I think the banking system's going to go flat. I think Fannie Mae and Freddie Mac's going to go flat. I posted this on a website of mine, and it took 5 years. So you say, I was wrong. No, I don't think I was wrong. Actually, I think I was early. So the people who said no one saw it coming, that's just not right? A lot of people saw it coming. They didn't know when, and people got tired of hearing about it. And so it wasn't just a handful. Whenever a CNBC person comes on who actually was on record, they say, oh, this is the guy who saw it coming. Yeah, this is one of 10,000 people who saw it coming. It was all over the place. It's just that the people, it was a guy from Citigroup, and he said, you have to keep dancing. And so when you will lose your job for not playing the game, even if you see the risk, you say, well, I got to keep playing the game or I lose my job. So my job risk is bigger than market risk. And that's kind of where we're at now. And so I've heard a lot of people say, this is a fantastic market, and it'll stay fantastic because the Fed's going to stay loose and the Fed's going to stay easy. And I think faith in the Fed's power is misplaced. I think faith in the Fed's commitment to jerking us around the way they have is probably misplaced. And so I am quite confident that regression to the mean will occur. I don't know when it will occur, and I'm somewhat irritated that the markets have been so jerked around by the Fed and by central banks that those of us who do not like investing in a rigged game, and those of us who do not like investing in a game that's overbought by virtue of printed money, we're forced to either sit on the sideline or take risks that we do not want to take, and I happen to be mostly on the sideline. So.
Yeah, timing is very difficult to predict, exactly when things are going to collapse, things are going to go up, things like that. So what you could be right fundamentally about certain things, about the yen, that it's going to fall to 150 to the dollar or 200. Timing is very difficult on exactly when. It could happen in 6 months, could happen in 12 months, could happen in 5 years. We don't know. But what Japan is doing is just ridiculous. The U.S. is a little further behind the path that Japan is on. But you speak with value, David Einhorn. He was a pupil of yours at Cornell, obviously not in finance. He's a value investor. I read his newsletter a couple months ago. It was very good, talking about the earnings game that companies play with analysts. They lower the bar, they beat by a penny. They humongous downward revisions in revenues, in earnings. 40% or more downward revisions each quarter, and then they beat by a penny. And these high-frequency trading algorithms, they don't recognize the downward revisions, and because the company beats by a penny, the stock goes up and it never drops, and it doesn't penalize the stock or management for not being able to operate their company with good revenue growth or earnings growth or anything like that. What's your opinion of the games with high-frequency trading and the games these companies are playing with analysts?
Well, so you're right about Einhorn. He does get it. He is. Some people know that, some don't. He's an extremely morally sound guy, best I can tell. I mean, when I talk to him, it's a little like deposing someone. He doesn't. He's a man of few words. So you ask him a question, you get kind of monosyllabic answers. And I actually got more information about him and about his thinking from his mother, who I had breakfast with one morning. His parents, and she actually quoted him. I can't repeat it. You know how much I love quotes. This quote was sufficiently dark and sufficiently personal that I kind of got to go to my grave with it. But let us just say that he's not an optimist. And he's maybe optimistic in terms of what he can do, but not an optimist about the system. And he's pretty outspoken about that. I don't worry about high-frequency trading too much. I will be irritated if a high-frequency algos manage to crash the system and damage it in a serious way. I think damaging people's faith in the system is probably a great thing. I think if the HFT guys once and for all showed the markets were a scam in a convincing sort of way, the flash crash was sort of a shot across the bow. If they actually damage the system in a way that really mucks it up in an irreparable way, I'll be irritated. But I don't think the flash, the HFT guys are skimming from the private investors. That's the interesting thing. So before HFT came along, you'd lose a few dozen basis points when you made a trade, right? You'd buy it and someone else would sell it, and there's a gap in there. I think that gap is what's being skimmed by HFT, and we would have paid that difference anyways. I think it's just who gets that gap. And so in some sense, I think the HFT guys are skimming the traditional traders on Wall Street. And I'd love it if a trader contacted me, if he hears this and has another view on it. But I think the 25 basis points we were paying to make a trade, that's the basis points the HFT guys are grabbing. So I don't think that the little guy should worry about HFT beyond the systemic risk.
Oh, okay. Yeah, that's interesting. I mean, there's so many different systemic risks out there. There's cybersecurity. There's hacking now that is going on. I think Jim Rickards said in interviews that the Russians planted some type of virus on the NASDAQ that could potentially crash it. And, there's Sony hacks. There's so many companies that But
the Sony hack was not the Koreans. I don't know if you saw that, but the Sony hack was not the Korean. That's actually a bad joke. The Sony hack turned out to be a disgruntled employee or employees. I'm not sure which. But they totally backed off on it being North Koreans, which I find really interesting because they came out and were extremely strong in their opinion that it was North Koreans. I couldn't understand that as possible because every time I see Kim Jong, what's his name, he's either riding in a boat that's 1945 vintage or is shooting a gun that looks like it came out of the Civil War. The guy's got no technology. So I didn't see how the North Koreans could possibly be the ones to hack Sony. And it turns out it was just a disgruntled employee, but I'm sure if they didn't have a nuke, we'd be bombing their asses off. And that kind of shows you, and I don't think it was an honest mistake. I think the Obama administration blamed the North Koreans because they said, look, there's no bad event that we can't turn into some sort of political hay. So let's do this one. Let's use this one on the North Koreans. It just shows the level these guys are willing to lie to get their way. And it's bipartisan, right? Who's ever in the White House is gonna use these lies, and that frustrates me to no end. I'll vote for an honest person. If I can find a person I perceive to be honest, I will vote for that person. They could be a damn socialist for all I care. If I think they're honest, they get my vote.
I think, Dave, there's just enormous hubris, whether it's the politicians, like you mentioned with Obama, coming up with the story to spin, whatever the truth really is, or it's the central bankers like Ben Bernanke, who I read about the David Einhorn dinner, and you told me a little bit about it that he had with Ben Bernanke, the hubris of Ben Bernanke that, oh, don't worry, we'll have everything under control. We're not going to let the dollar collapse. We're not going to let inflation get out of control and things like that. I mean, this hubris, if you go back through financial history, it's the same type of hubris from failed governments, from hyperinflations or collapses of societies and things like that. And it just seems that the people in power, they just want to maintain their power. They don't really care about the long-term consequences of anything they do, as long as, in the short term, they maintain their power and they're keeping most of the status quo intact.
Yeah, actually, the part of the Einhorn story the press missed was that he actually got Bernanke pissed off. He didn't just ask him questions, and there was a Zero Hedge article that picked up on the conversation. But what didn't get mentioned is he pushed Bernanke to the point on questions pertaining to why you feel it's important to pump up the market. And Bernanke denied it, and Einhorn went at him, and Bernanke got mad. And it's a good question, right? These guys somehow think it's so. If you and I bid up the price of each other's house, and do we get to mark up our net worth because of that? No, it's the same house, doesn't matter. And so bidding up stocks, that doesn't change wealth. It changes the claim to that wealth, and that is if you bid up stocks, whoever gained the system the best has the highest percentage ownership. But the stocks are not worth it. The companies underlying the stocks are not worth more. I don't know what these clowns are doing. Actually, it's getting kind of irritating at this point, where they somehow seem to think that if you can increase the sticker price of something, you increase the value of that thing, and that's just not true. That's just now. I'm praying. Well, I don't even know. Either they're liars or they're idiots, and I just don't know. Maybe these are just mid-level bureaucrats who don't get it.
I think they're committed to
stupid.
They're committed to Keynesian economics like bad religion. I think the wealth effect, there's a whole, without spending all the time talking about the wealth effect and how it fits in with financial repression, and we could probably spend the whole podcast about this. There's government tax revenues that come in based off higher asset prices. So that's one of the reasons. And the Keynesians, one of the things Keynes wrote about in the general theory, and Henry Hazlitt talks about this going through line by line in Failure of the New Economics, is Keynes didn't want everyone to have savings, but he believed that the government, through printing money and QE programs, could do something, could boost the economy in lieu of savings. So the Keynesians believe instead of people, having higher incomes and having savings, that they can, force their housing prices higher, and that'll mean the economy's good. So there's a whole bunch.
But to be fair to Keynes, he put out these theories in a time when the situation was very different. So imagine you have this gigantic pile of fuel that you just can't get lit. And he was basically saying, look, there's ways to light it if you can. And he was viewing the money printing as a catalyst, I think. And a catalyst is something that takes a reaction, a chemical reaction that would like to go in a certain direction, but it just doesn't have any mechanism to get there, and give it that mechanism. And so he was trying to find a way to get things moving again. Now they're using it in a different way. They're now trying to take something that's not meant to go and make it go. They're trying to pump it uphill. So Keynes was trying to figure out how to get the water to flow downhill by breaking some dike. And Bernanke and these guys and Yellen and all the rest of the losers, they're trying to figure out how to pump the water up the hill. And that's just a different story, and they think they can pump money in. Now, here's Keynesian economics that I could endorse. If the government acted like an interested financial party, then what the government would do is they would buy goods and services when they're cheap, and they would stop when they're expensive, and it would be perfectly countercyclical. And so when you could get cheap labor and cheap goods, then you build your bridges, you build your roads. And when they got too expensive because the private sector was battling for those goods and services, you step back, right? That's a utopian Keynesianism that makes total sense to me.
I don't know a Keynesian who would do any of the things you advocated.
You're absolutely correct.
They've just gotten so hardcore Paul Krugman that they don't want to ever take the foot off the gas pedal. They just, I have a different view of Keynes. I don't really want to spend a whole bunch of time debating it with you. I basically think he's almost a Marxist. I think he was a total hypocrite. He was front-running gold stocks and making money off gold stocks while bashing gold. But anyway, though, I want to transition to the oil price drop. You said that was one of the hugest surprise. It's been an enormous drop in the oil market. Why do you think the oil price dropped so much?
Well, I put forth the theory. That was one of the few surprises that was a surprise. So, in the housing market collapse was, oh, what a surprise. The dot-com collapse was, oh, what a surprise. That's all baloney. There were plenty of people calling it. The energy, as much as I read a lot about energy and stuff, these guys, at best I can tell, people did not see this coming. So the first whiff, in my opinion, the first whiff of an energy drop that I got, and it's conceivable someone at Goldman started yakking about it because he knew the Saudi princes or something, but the Saudis came out and flat out stated that they would be happy with a lower price of oil. And that started the whole thing. And now your readers know, your listeners know, that the Saudis don't want a lower price of oil because somehow they want to make less money. So they have an agenda. So the question is, what's their agenda? Now, that's where the theories run rampant. One theory is that there's just a supply glut, but then, of course, the price wasn't showing it at all. The second theory was they want to knock out the frackers, but if they were selling oil at 110 a barrel, the frackers weren't even doing damage. And so I think it was pure geopolitics. I think it was geopolitics of a higher order, and my thesis on it is that it contemporaneous to the Saudis declaring that lower oil price was fine with them, and it got worse and worse. It got down to, you got some Saudi oil minister saying that, oil's going to go to 20 and never come back. That's not exactly talking your book, right? That's kind of insane. And so there's a reason why they're doing this. And the Saudis started bad mouthing oil at exactly the point in time that the ISIS guys were doing their desert fox run across the desert and taking out various organizations and commandeering all sorts of resources, and they looked like they were headed for Saudi Arabia. So all of a sudden, Saudi start talking on the price of oil, and we start bombing ISIS, and it all happened contemporaneous. And I think we cut a deal with Saudis. I think we said, look, we're pissed at Putin. We want you to hurt Putin by dropping the oil price. We will take out ISIS. We'll call it even. I think the Saudis said, okay, deal. That's it. Now, how do I know this? I don't. It's just an opinion. Some guy gave me grief this morning saying, you should talk about what you know. And I said, well, that would be nothing. Everything's just a guess. So I have to talk about the guesses.
Well, the oil market, in your defense, Dave, the oil market is shrouded in so much geopolitics. I mean, it's the majority of the oil production, the majority of the oil reserves is still owned by national oil companies. So if they want to, we saw this in the 70s, with OPEC, what they did with the oil price then. If they want to move the oil price a certain way, they can. I mean, people are saying, oh, the Saudis don't have power anymore. I mean, clearly it looks like they did most of this on their own. Maybe Wall Street had some help with the derivatives market with oil, but it looks to me like, a concerted type of effort like you described, because I've interviewed for our podcast, I think, about 6 oil experts in the last couple weeks. I don't think there was really any fundamental justification. I just saw a video that CNN Money just put out talking about the oil price, how it was all drop in fundamental justification and supply and demand. There was oversupply on the American market. It flooded the global oil market with oil. The demand from Europe and China dropped so much, and the data doesn't indicate any of this. The IEA said, yeah.
Well, but that person's just ignoring the fact that the whole thing was started by the Saudis talking the price of oil down.
Well,
right?
they don't want to live in a. They don't want to. I agree with you. They don't want to live in a world, though, Dave, where they have to cite conspiracy theories or geopolitical backdoor discussions or things like that. They want an easy 2-minute, fundamental justification for something. Say, look, we found these 2 data points, and that's why, and you should believe us.
Yeah, and it's probably scary how little they're working with. The other thing is that there's a number of people who are basically on payroll. If you read Frank Rich's book on Bush, which Frank Rich did not like Bush, but Frank Rich is a Pulitzer Prize winning journalist, and he said that Bush had 120 journalists on payroll. So when an administration decides it's time to move something, by that math, they got 120 journalists to start dropping bombs out there. And so the fact that you can find journalists writing stories about how it's supply demand, that's fine, except for the fact that you can't get around the harsh reality that the Saudis said we want lower oil, and there's not a snowball's chance in hell that they really want lower oil just because they like to be good guys, right? They wanted lower oil because they wanted something else in return, and I think it was bomb and ISIS. And who knows what it could be? Maybe it was something else, but it was not. Fundamentals might have made it easy. Possible I'm describing the trigger, not the thermodynamics of it all, but I don't have any doubt that the trigger was the Saudis talking it down, and the rest of OPEC looked like they were squealing. They looked to me like they're going, oh no, don't do this to us, right? The Venezuelans certainly got crushed.
If OPEC knew the oil price, the rest of OPEC knew the oil price was going to drop, they would have hedged, right, at a much higher price, and they would have been fine.
The Saudis probably did. See, that's the key. Is if the Saudis wanted to drive down the price of oil, what would you do? Well, first of all, you'd bad talk it, but before, first of all, you would hedge. So the Saudis were probably out there shorting oil down to the basement. Right? They can enter those financial markets as well as anyone, and if they know they're about to go down the tubes, then it's a perfect opportunity to cover their own bets. So the Saudis probably made a fortune on their hedges.
Yeah, that's interesting. I think there was clearly financial warfare involved in the dropping of the oil price. The fundamentals, in my opinion, I've researched the fundamentals a lot. Besides myself and also interviewing a number of other experts, I don't think there was any fundamental justification for the price drop, really. And I think like this oil drop here, people have cheap gasoline now. They should enjoy it while it lasts. I'd be surprised if it lasts another 6 months or so. I mean, the rig count's going to drop like crazy now. There's going to be bankruptcies now. There's a lot of carnage in the oil market. So I don't think any of this is sustainable.
Well, so the other sort of frustrating part of this is the guys who made the call, I don't know where this decision was made to crush the oil market. It's got to be tied to Putin. It's got to be tied to trying to hurt him. Right? That seems like the most logical motivation. I'm guessing they didn't think of all the knockoff effects of crushing the oil market. I don't think they understood that they could destroy the high yield bond market, and they could bring down financial institutions in the process, and they could bring down an entire domestic energy industry in the process. I think they were just looking at Putin and saying, we can hurt Putin, right? It's like, well, yeah, fine, but the collateral damage was huge. And, of course, these are probably the guys who view collateral damage as just totally acceptable. So they're just political hacks.
I definitely agree. Knowing a lot of the people in D.C., I live right outside of Washington, D.C., this is exactly the way they think, many of these PhD people. They wouldn't look at production costs. They wouldn't know that oh, if we take the oil price down too much, we're going to bankrupt our own oil industry, when the U.S. politicians, a lot of them here in D.C., are saying, oh, we're going to be energy independent. We're gonna produce all of our own oil and all these things. Well, it's not going to happen anytime soon, because these shale oil producers 12 months from now, a lot of them are going to go bust. They're they're going to default on their debt. I don't even know if they have 12 months, some of these guys, because
Well,
they're not properly hedged.
I don't think this even gets into the world of conspiracy theory. I'm a big fan of conspiracy theory. I think men and women conspire, and I think our job is to figure out what they're conspiring about lately. But if I were to get very dark, I'd say, look, maybe someone there knew that this debt bubble was about to burst and they needed cover. So they say, well, let's blow up the energy market, and then at least we'll be able to blame that. So, if you need cover, you create a mess. So maybe it's almost like a false flag move on the part of someone. I don't know. I can entertain anything. If the LIBOR scandal was in plain sight since '08, and no one noticed it until 13, and I can believe anything. It's short of almond-eyed aliens and Roswell Park, and I'm not a big fan of some of these ideas, but geopolitical moves like this, they can do anything.
There's a lot of WikiLeaks proof about this. I think like some of the stuff that Julian Assange got from Bradley Manning, it said how the U.S. had already started, I think, in 2009, 2010, planning their attack on Putin. One of the first moves, I think, was to destabilize the Ukraine. I don't know if it talked about destabilizing the Russian ruble in there, but obviously, they don't even have to go fight really a conventional warfare anymore. We have financial warfare now. With all these, the derivatives markets are so large, the financial markets are so enormous and complex and bigger than the real economy. You could just destroy someone's currency. Russia made it kind of easy on themselves with their whole economy. They don't have a diversified economy. That they were so reliant on oil and gas, where they left themselves open to the U.S. That's how the U.S. got them. One of the reasons the U.S. put the nail in the coffin in the first place on the Soviet Union in the 70s and 80s was they helped. There's books now out about this and documentaries about how they took the oil price down from $40 a barrel, I think, back down to 10. And, it helped bankrupt the Soviet Union, too, because the Soviet Union took out enormous amounts of debt when the oil price was at 40 back then, and then it crashed, and the Soviet Union was in enormous financial problems. So I think there's a lot of historical evidence that a similar type of game was played.
And they can think that, and they can say, oh, we'll do financial warfare. But first of all, the Russians are tougher than us. They've learned to live with less. They survived the siege at Leningrad. I mentioned all of this in my year in review, where you look at a Russian dash cam, right? They live under harsh conditions, and we're somehow trying to make them hurt. We don't know how to live the way they live, and so we could lose that battle, because our idea of suffering is waiting in line for an iPhone overnight, and by the way, who says that if we pick a fight with Putin, that he's going to use financial warfare, right? And just because we think, oh, this is a financial fight, well, maybe not according to him. And so you corner a guy like Putin, who, by the way, has a popularity rating in Russia, which is a decimal point above that of Obama's here. Who's to say what his response is going to be, and who's to say we're not going to end up with some conflagration at the end? And I'm going to blame us for that one. It's not that I'm supporting Putin. It's not that I think he's a good guy. He's a KGB, right? He's a tough guy. But we picked the fight. That's the key. We didn't have to pick that fight with Putin. He wasn't threatening us, best I can tell. And if he was, someone better step up to the plate and tell us what he was doing without lying, because it looked to me like we picked the fight, and we are going to live with what the outcome of that fight is. It's not over. It is just beginning.
Yeah, I agree. There's going to be unintended consequences. I mean, we're already starting to see these enormous amounts of currency swap deals, these bilateral trade agreements. China, I think, has already done at least 20 of them on large scale with Russia and so many of their other trading partners for natural resources and in Asia and things like that. And the infrastructure was not in place to replace the petrodollar, to eliminate the U.S. as the sole world reserve currency. before 2008. So all the experts are saying, the U.S. is going to lose all these things, but now we're starting to see the infrastructure in place because, people like Putin, people like China, they're getting fed up with the behavior of the U.S. government. So I completely agree with you there. Our government, like living outside of D.C., they're in a bubble. These are central planners. They're very book smart people. They're academics, a lot of them, who are getting very high paid government jobs. Some of them are getting, paid whether it's $40 million to come up with new things for torture or seven-figure lobbying deals or other stupid government projects. These people just don't understand reality, and yet these are the people that represent us when our country, our government, is dealing with foreign governments or foreign entities. It's just very frustrating for someone who lives right outside of D.C. And I look for honesty and truth and things like that, and in D.C. you don't see any of that.
Yeah, and then the other, so let's say we corner Putin, let's say he decides to pull out the energy card, right? So let's say he says, okay, guys, I'm cutting off energy to Europe, right? If you're going to make us suffer, we can suffer. We've gotten through long winters before. We'll do it again. He cuts off Europe. Who do you think the Europeans are going to be mad at? It's not obvious. They'll be mad at Putin, of course, and they'll be upset, but they're going to be looking at us too and saying, what did you guys just do? Why did you do this? Why did you create this mess? Merkel was trying to stay on Putin's good side. She didn't want to pick a fight with Putin, and then finally, so what happens? She's cozying up to Putin. What do? We sanction Deutsche Bank, right? We hit Deutsche Bank with a $10 billion fine. Tell me that's not financial warfare against Germany. If I was Germany, I'd be so mad at that. We didn't do that to anyone else. We did it it was such a mess. So we started hitting the European banks with fines, and they know we can shut down their banks through the various electronic systems that we control. And so all of a sudden the Europeans get in line. They're not happy about that. They're mad at us.
Yeah, I completely agree. It's just so ridiculous. Some of these policy moves, they seem to conflict with each other, Dave. So, one government agency here in the United States is doing one thing, and then another government agency, it's not like they talk to each other, is doing something completely contradictory to it. It's just really head-scratching in a lot of cases. You got one government agency trying to stop two companies from merging, right, saying it's monopoly or something like that, and then you get others trying to, prevent Uber and all these other guys from competing with monopolies. So it's totally hypocritical and ridiculous. I've stopped trying to rationalize any of the stuff that the government does in terms of their behavior because, 1 minute they're protecting a monopoly or an oligopoly, and the next minute they're trying to break up certain ones or prevent.
But they're breaking. Anytime you see them trying to break up a monopoly or oligopoly, ask who wins, right? Cui bono, who wins, and you will find another vested interest behind it, right? There's nothing done out of Washington that doesn't have big money backing it. It's just which team has put up the serious money and where the favors do, and so if you look at Mattel backs testing, lead testing in toys, right? And you go, oh boy, that's very community oriented. No, it's not. They know that the little toy makers can't afford it. So that by backing lead testing, they can test toys on scale, whereas the others can't, and it so bankrupts the little guy. So when you see a big company supporting what appears to be regulation, don't be surprised that regulation is designed to hurt little companies, and they're the bread and butter of our economy. So
yep, all the jobs are created. Yep,
right,
70%, right?
That's the rumor. I'm not so sure about all that job creation, but yeah, that's where they're supposed to be coming from.
Okay, well, I want to transition now to civil liberties. You covered this extensively in your year in review. What's your opinion of 2014-2015? We had Edward Snowden in the last couple of years, Julian Assange, whistleblowers and things like that. It seems to me things are accelerating. We have this FACTA, or FATCA or FACTA, Foreign Account Compliance Act, seems to me to be a version of capital controls. They're trying to make it extremely difficult as an American to get your money out of the country now, or to do business, outside the country, and then get the foreign bank to agree to compliance issues with the U.S. Are we starting to see the full police state here and the full, capital controls of a full totalitarian regime?
God, I hope not. I wrote a lot about it. I didn't go at the national level though, or the international level, should I say. So I got to confess a bit of a mixed emotion. So when there's a company here and they're supposed to pay taxes, forget about whether you should pay corporate taxes or not. There's different opinions on that. But if you have corporate taxes, then you should pay them. And the reason is because not everyone can duck them. Right. And so I think things that say, look, if we're going to put in, X% corporate tax rate, then everyone gets to pay it. And that way, then it's back to the little guy getting hurt. If you can, if you can offshore all your profits and therefore not pay tax, then have a tax amnesty, which they miraculously have about every 5 or 6 years. That's not fair. I have mixed emotions about U.S. citizens, ducking taxes going offshore. Again, I'm not a big fan of taxes, as you can imagine, but at the same time, I'm not a big fan of a situation in which a select group can get out of them, whereas the rest of us end up paying them. I can't go offshore, right? I could, but I'd get crushed. They'd beat my butt pretty hard, and so in that sense, I'm not so sure about that. The police that I worry about is at the local level. It's civil forfeiture. It's cops beating on people with no consequence, and it's not about a specific case. I don't know if Michael Brown deserved getting shot. I mean, no, I guess deserves getting. Well, yeah, actually, people do deserve getting shot. Some of them, but I'm not sure he did. But I do know that it opens up a serious question as to what will keep the police in check? What will keep them from acting like a standing army in the United States? I am sure that most cops are good. I don't know what percentage to put on the number most, but I'm willing to concede most. But it's also true that if most of the cops who are good stand by and let the bad guys be bad, then the good cops are part of the problem. And so I think the cops are going to have to clean up their act from inside. I think that the 2 cops who got assassinated by all probability were not bad people. They were doing their jobs, right, statistically. But I think things like they're going to keep happening because people are lashing out of anger over in an abstract way. And so I worry about this. I think Ferguson represents an important point in history because it was this incredible group of unempowered people, right? And this is inner city dwellers. These are people who have never been able to amass any kind of power. You could maybe go back to Martin Luther King and say there was some, right, when they had bus strikes and stuff like that. But it's been years since they had any power whatsoever, and they figured out how to use social media to empower themselves. And so the next time some black guy gets shot, whether it's a valid shoot or whether it's an invalid, it's not going to matter. The society figured out how to get mad in a way that can be rather destructive. And
yep.
I think that's a big issue. And I think as long as the cops keep giving them reasons to get mad, I think we have a problem. Even if it's nowhere near as frequent as people believe, even if the bad behavior is pretty rare, if a good cop doesn't deal with the bad cops, then they're part of the problem.
Yeah, from a historical standpoint, Dave, I was born 1982, but looking back in history, it seems like we're kind of re-entering a lot of similarities from the 60s and 70s again. But one thing I think that's causing a lot of this underlying thing, if the economy was better in the United States, if more young people didn't have as much student loan debt, they had a good full-time job that was high-paying, they had a chance at promotion and upward mobility, they maybe could find a good relationship to be in with friends and or a boyfriend or a girlfriend or things like that, right? They could afford to buy some assets or travel, have some discretionary income. I don't think nearly as many of these problems would be happening. But, the economy is not nearly as good as the mainstream Keynesian aggregate Bureau of Labor bullshit Labor Department and BLS BLS statistics are saying it is. And, I think it's starting from that, and people are saying, the economy is bad. There's a lot of people in my demographic, Generation X, Generation Xers and Millennials. We have too much time on our hands. We have a part-time, I'm speaking in general about my generation. We either have a part-time job or a couple part-time jobs. We're barely getting by, barely paying our bills, and it's causing a humongous amount of anger because there's not that much opportunity for us. My generation, we're probably going to be one of the last first generations in 70 years or so where maybe our adult lifetimes are not going to be better than the generation before.
Well, the boomers are going to have an inferior retirement. That's that's more predetermined than your generation having a tough time. Your generation has still got too much error bar in it to know, although it doesn't look good, I must admit. But the boomers now, if you actually do the math, they've already committed a bulk of their adult existence to breadwinning, and they're now broke. And so the boomers lived a good life for most of their adult life, but I think that the twilight years are going to suck eggs. They're going to be bad. Again, we're always talking bell curve demographics here. There's boomers who are going to be fine, but the median boomers in a world of trouble, and it's too late. The metaphor I like is going down the Niagara River in a barrel, right? You are going over the falls. There's no more options. There's no more choices. You're 60 years old. You've saved 1/5 or 1/10 of what you were supposed to save to be safe in retirement. And you can say, well, I'll just work till I die. It's like, yeah, or until someone fires you because you're too old and doddering to do it, right? And I have a lot of friends in pharma who get released at around 55. They maybe it's age discrimination, maybe it's not, but they manage to clean out the old wood pretty fast in that industry, and I'm sure other industries as well. So no, and then the unemployed young punks. They're getting such a bad start that you're right, they're mad, and they have a reason to be mad, I think. And, part of it's their own doing, right? If you go off to some lousy college that costs a fortune and then major in something stupid and party all the time, there's some self-infliction of that wound, right? But at the same time, there's kids who did it right, who really followed their dream and thought they were doing the right thing and tried to make good decisions, and they're still unemployed. And, those guys got the shaft. And the student debt issue is huge, and it's not going to go away easily. And I don't know how it's going to play out from here.
Yeah, I think it's a mess, and that's a good point about baby boomers. I think baby boomers, they've had it pretty good for a while, and now, they're left with the bills, and their incomes are not rising. If they have a full-time job still, I know a good amount of baby boomers from my parents' friends and other people we talk to thanks to this podcast who, have been let go from their full-time job, and they can only find part-time work. And
right.
They need, full-time income. So, incomes aren't rising, and there is clearly still inflation. My food bill since 2005, my food bill has gone up quite a lot. And the CPI is not accounting for this. My healthcare bill's up substantially. So there's evidence of inflation here. Where do you stand on the inflation versus deflation debate, and where precious metals fit into this debate then?
Okay, I've gone more agnostic in the sense that I think we're going to have one of them. So I'm not saying all of a sudden we're in some Goldilocks. Goldilocks is on the steeple of a church waiting to go one way or the other. I used to be a diehard inflationist. I sincerely believed Bernanke when he said a determined central banker can trigger inflation if he wants to, and then recognizing that these guys were determined, I said, well, therefore, there will be inflation. And the Austrians all say there will be inflation. But it's not part of the Austrian creed. It's the Austrians were the ones who could see the problems coming because the bigger the boom, bigger the bust. They saw the bust. They were all guessing inflationary bust. But the Austrians know full well you can have a deflationary bust too, right? They're the ones who got the Depression right, in my opinion. So the fact they called inflation just means they made the wrong call potentially. So what would the deflation look like? Well, first of all, deflation is a lousy debate because it's a binary pair of terms that are incredibly simplistic sounding to describe a phenomenally complex thing. So I said describe the weather using one or two words, you would fall flat on your face. And that's true with inflation, deflation. But deflationary pressures include things like collapsing banking systems and debt defaults, and those all look pretty deflationary to me. And I'm not convinced a determined central banker can have that off at the pass. In fact, a determined central banker appears to be instigating those, right? So I'm a little
Yeah,
less convinced that it'll be all inflation.
It's just so complicated now. I think it's kind of a stagflation, and it's just everything's getting mucked up by whether it's politicians or Congress in one country creating bad tax laws and destroying an industry and forcing one industry to another country, or it's asset price inflation that Japan has caused globally. The yen carry trade has just caused enormous amounts of asset bubbles outside of Japan, and in the quantitative easing programs from the United States. China, their central planning has caused enormous overusage of base metals and all these other things. So I agree with you. It's a little bit more complicated than just inflation or deflation. I tend to divide everything up into about 6 categories, but when you one category may be deflationary, one may be inflationary. When you kind of look at all the different categories, though, and add them all up, it kind of looks like a weird type of stagflation, not quite like the 70s, in my opinion. I think that's the best thing the central banks can do at this point. They can't get the central planners can't get everything they want. They can't get the wage growth from the inflation. I mean, ideally for the Keynesians, right? They'd be getting the wage growth. They'd be getting the wage growth besides just the wealth effect, and they're not getting that, but they're getting enormous asset price inflation. And then, we have the dollar pegs, and a lot of the inflation is exported to China and Brazil and Russia and and India and things like that. So it's just all one complicated mess, and I'm trying to figure out a portfolio for myself that can kind of survive both.
But there's an absurdity even to their design. So they seem to think that they can simplify the inflation-deflation debate to relatively small number of things. I don't think that's true. So let's follow through on the wage inflation. So they get wage inflation. Well, what happens next? Well, then corporate profits drop to zero. And now all of a sudden you're going to have asset price deflation because to pay for earnings that don't exist doesn't make sense. And so the record profit margins of corporate America that have been boosting their earnings would get crushed if they got wage growth inflation, and therefore the assets will plummet. And as the assets plummet in value, you still get a crushing hit on the economy. And so I don't think these guys know what they're doing. They're twirling knobs. They think they know. It is what Hayek called the fatal conceit. These guys are twirling knobs on a complex system with an infinite number of feedback loops in it, and they think they can control it. And that's absurd. Right? That's delusional thinking of a higher order. Yet they somehow manage to think it. And if they don't think that, then it means they're lying their asses off and they're just trying to hang on by their nails and buying time. And I'd like them to stop lying, right? I'm not impressed by that either. So I can't write a good scenario for the Fed that makes them come out looking okay. I think they suck.
Yeah, I agree. They've turned into politicians now at this point, talking the markets up or down or however they want, trying to prevent asset bubbles here or things like that there. Too much inflationary pressure here, too much inflationary pressure there. And one thing about Keynesian economics and Wall Street in general, what you don't like is, and I think this comes from Keynesian economics, is they think that they can come up with the perfect model, that they can model this complex system, like you said, that is the global economy. There's so many different variables and things like that. It's just impossible to accurately model it. But yet, the one guy who does a model and it's remotely close that predicts the oil price drop, everyone's going to cling to him and think that he's an expert now going forward. He might go after getting this one call right, he could go 0 for 500 after that. So I mean, it could just be he was at the right confluence of time. He got the right thing, a lot of the right things involved, but there's no guarantee based on linear thinking, confirmation bias, and all these other things. He's going to be able to continue to do this, day in, day out. And I think that's the problem in general with Keynesian economics, and why the Austrians are right in general about the economy and trying to model it and do central planning and pull this lever here, that, like you said, and predict what the consequences are going to be for the behaviors.
Yeah, well, so the economists discovered math. It makes total sense to me because academicians are always looking for ways to be scholarly, right? That's kind of our job description is to find some seam somewhere and carve out a niche and hope it's really an important niche. And, hope if you're a chemist, you come up with some drug that cures cancer or whatever. But the economists discovered math and said, oh, this is fantastic. We can apply higher level math. I thought it was Samuelson who actually got credit for that. But in any event, and that's fine. I think it's fantastic. The problem is, unlike chemists or biologists or whatever, these guys then take their mathematical models, which are far from accurate, and then they release them to the wild, right? And they do crazy things with them, and they're making gigantic decisions with them, and their models are not ready for that. And so I don't know how to stop them from trying to run the economy with their models. And that's where the Austrians have it right. That's where the free market guys have it right. Just let the Darwinian selection pressures of the free market keep constantly adjusting supply-demand curves, millions of supply-demand curves, and to just keep knocking it back towards equilibrium. But instead, the Federal Reserve, what kind of fools are these guys? So they'll sit there and they go, oh, look at this. Interest rates are climbing, and we don't want them to climb, and so we're going to drive them back down again. So these guys are saying, look, the free market has spoken, but we don't like the answer. So we're going to change it, right? That's just stupidity. I don't need to be an economist to know that's just a dumb person who would think that. That's like saying, if these guys were biologists, they would say, the elephant's too fat. Let's put it on a diet. Its legs are too stumpy. Let's add some extra legs to it. We can make a better elephant than that. Biologists at some level do this on a microorganismic scale, but when you get to a big, complicated one, it wouldn't work. And you can say, well, what about, domestication of animals? It was done through a selection process. We domesticated cows through eons and through tremendous numbers of iterations. And we didn't all of a sudden just take all the cows of the world and change them. And they refused to let the free market call out the bad ideas. They refused to let the free market call out the losers and keep the winners. And even the microchip, it wasn't invented, not in a normal sense. The microchip evolved through thousands upon thousands of trial and error experiments, in which some of them turned out to be really key. And you say, well, that was a central one. Yeah, well, that's true with biology as well. That's true with Darwinian evolution. But the fact is, you only got a microchip because there were countless failures along the way. And the failures got called out, and they just kept getting better and better, and you end up with this miracle we call a microchip. But some committee didn't invent a microchip.
Yeah, these Keynesians, Dave, I would best describe them as speaking to some of them, especially ones with Ivy League degrees, listening to them speak, on CNBC or Bloomberg from different central banks. I would describe them as, and reading their white papers, I would describe them as blind ideologues, and they have a version of the world. They have types of results they want to see in the world, and then they go and they reverse engineer formulas or things like that, trying to centrally plan, engineer with models and formulas or economic monetary policy decisions, the world they want to see. And they don't anticipate any of these unintended consequences or a thing like that. They end up doing, more and more damage than good that they see. So it's like I think the saying you're in chemistry, so it's like the cure being worse than the disease.
Right.
Well, my final question for this discussion here on 2015. What do you see about the precious metals market here? We've seen a cyclical bear market really for 3 years. Do you anticipate the cyclical bear market coming to an end in the near future then?
I don't know. For the first part of the bull market, which started technically in 01, I owned metals on the way down from 99 to 01. That was a tough period, by the way. When you're buying something that you think you're nuts to buy, and then you have to put up with 2 years of even modest losses, you feel pretty stupid. But then we went through from 01 to around, I'd say 08-ish. And the metals kind of quietly did their thing, and they got occasional discussion on CNBC, and no one seemed to care. But they've gone geopolitical now, and so you've got all these stories about German repatriation and Dutch repatriation and French repatriation, China buying gobs and Russia buying gobs and us grabbing it up from Cyprus and grabbing it up from Ecuador and grabbing it up from various places. Once it became overtly geopolitical, I don't think it was ever not geopolitical, but once it really livened up, then the normal indicators, the normal sort of indicators that tell you what's happening in the market become untrustworthy. So I noticed today gold closed at 1198, right? And you go, well, what does that mean? What was it, 12 something, and then it snuck to 1198? And isn't this the last trading day of the year? And then my paranoid brain says, is it possible someone wanted to make sure there was an 11 handle on gold at the end of the year, right? 1198, they park it. I watch them park markets every day. That's I can tell. I wouldn't have believed it, but I watch them ramp and camp it every day. And so
probably
if
some
someone
option.
wanted it low, if someone wanted it sub 12, they can take it sub 12 with a modest amount of money, and then it produce headlines, right? That gold closed in the 11s for the first time, and blah blah blah, right?
Yeah. Yeah, there was probably some options contracts that someone made some money on that expire now worthless because they didn't close in the money at 1200 or something. There was probably something along those lines.
Right. But until it shakes these sort of shackles, it's who knows what it's going to do. I'm holding on to it though. I don't trust the paper money.
Well, I don't know how high they're going to go in 2015 or 2016, Dave, but I can tell you from a supply-demand standpoint, which is reality, right? So whether or not the paper markets, in my opinion, are grossly manipulated, the paper markets, but this hurts the miners, the producers of the metal. So they've had just worse. Their input now the oil price has dropped a little bit, so maybe their input costs will drop a little temporarily, but their costs have risen and the metals price has gone down. I mean, these guys cannot really survive prices at these levels. There's going to be bankruptcies and mine closures in 12 months or less now. I study these mine companies more than you do, and I can tell you that they can't survive if the prices go much lower. So either demand for the actual metal is going to have to drop. If demand goes much higher because the mines are close to closing, the prices are going to have to go higher. So something's going to have to give very soon in the near future. I don't think, looking at the financial statements of a lot of these gold and silver miners, I don't think that they can survive another 12 months of this at this point. They're at a point where either they have to close down the mine and or go bankrupt or sell out for pennies on the dollar to a larger miner who can run the mine more efficiently, or the price is going to have to go quite a bit higher to so where the miners can make a profit. So one of these other things, maybe the metals in the short term will go a little bit lower, but then we'll have the last washout because then there'll be bankruptcies from the miners.
Well, in a geopoliticized world, though, you do have situations like in up to '01 where the Bank of England was selling gold for geopolitical reasons. So that's why I'm not as optimistic that the miners not producing gold will necessarily move the price of gold because there are some deep-pocketed possessors of gold that, in theory, could satisfy the market's demands at least for a while. Eventually, it gives way. I agree with you. I'm just not sure that that there's a strong connection between what the miners can produce and what the gold market can demand and the price of gold.
Well, from talking with my contacts like Eric Sprott and many others in the precious metal industry, I've interviewed a lot of experts. I think the supply for actual metal, not the paper market, is extremely tight for both gold and silver, especially for large orders of gold, 400-ounce bars of gold. For silver, it's large amounts of silver. Those orders are very tight right now. So I think there's going to be some problems here. And I think a lot of the supposed gold reserves, I don't think it's unencumbered gold. So, the U.S., so I think a lot of that gold is already gone. I don't think the West has that much gold left. I think I think GLD is probably the largest holding of physical gold in the West. If there's any gold.
I don't even know how much GLD holds. I heaven only knows. I'm not sure it's not fractional reserve and how much.
Yeah, I think there's multiple claims on those bars too, but I know the Netherlands got 100 tons, of their gold back, but I think a lot of it probably came from the GLD more than the New York Fed, but we don't know for sure. they're not going to let us in the vaults. They're not going to allow independent audits of the vaults. Like you said, gold is just so geopolitical. They don't really want the truth about gold. No.
So here's the cool thing about GLD is if the GLD was fractional reserves, let's say you start out with a 5-to-1 claim to gold ratio or something like that. And if all of a sudden people start pulling out the gold out of GLD, then all of a sudden it's gone up to a 10-to-1 fractional reserve. And so at some point, GLD no longer serves as a source of gold. If it's fractional reserve, it doesn't serve as a source of gold because the gold does not exist, right? You could empty GLD's gold if it's fractional reserve. You have a run on GLD.
Well, private investors, I think they've already created the paperwork in the prospectus, right? So in GLD, and also the COMEX has this too, where there can't be a run on the COMEX for gold or silver. Someone can't stand for delivery and blow up the COMEX for gold or silver.
Yeah, but that becomes a default, though. That becomes a default. If all of a sudden you can't get gold out of the COMEX, then the COMEX goes to hell, right?
Well,
so the day you're supposed to get your gold and you don't, that's a default. That's like breaking the buck or something.
You and I both know that's a default, but they can say, oh, you have to wait 6 months or a year, or oh, we'll offer you 80% premium cash settlement or something like that. They've had fires, physical fires like that in the past. If you followed Gatto's work, where there's been shortages like that, and they've put them out in the past, but it hasn't been prolonged for a long period of time, where it's been month after month after month, where that's been the case. But I mean, haven't they changed the rules though in the prospectus for GLD, where I think you're friends with a money manager, right? And he tried to redeem his shares for GLD, and he couldn't get.
Yeah, but that started that way. It turns out that was not a rule change. That was Tony Deaton. And it was as far back as 06 or 07. He tried to take $50 million worth of gold out of GLD with a team of lawyers, and they said to take a hike. What came out of that story was the only people who have the legal authority to take gold out of GLD were the 20 big banks. So as the market breathlessly through 2013 reported liquidations in GLD like it was some bad thing, right? Like it was some horrible event going on in the gold industry, and it showed the carnage. I'm sitting there watching this going, wait a minute, let me see if I got this right. The GLD is being liquidated by the banks. They're being the gold's being taken from GLD by the banks trading in their shares. Please tell me why that's bearish for gold.
Yeah, I agree.
It's bullish for gold. It means they want the metal, not the paper.
Well, all this, I agree, and all the stories for gold, like by Wall Street and the investment banks, are all negatively spun. So they're all, leaks, or they're all spun like that. And to add to your point there about the gold being pulled out of GLD, one of my friends is a money manager, Dave Kranzler, if you're familiar with Dave. And,
I know Dave Kranzler, yes.
Yeah, and he subscribes to a very expensive gold newsletter, and the guy has sources all over the world for gold, all through Asia and India and China, a lot of gold dealers. And I think what was happening is Wall Street was pulling a lot of that gold out of GLD, and they were selling it on the Indian black market for over $200 an ounce premiums. So, and they were saying how bearish this was for gold, but look at the demand. So it's just ridiculous how everything's spun in the gold market, how the West, the chart's bad in the West. So most people in the West won't buy something with a bad chart. There's just many Keynesians and people on Wall Street who hate gold. It is what it is.
My bet on gold has morphed from an inflation hedge to a bet that the global currency regime at some point is going to morph into a gold-backed system. Now, I'm coming to terms with that idea, which last couple of years has been evolving. The belief that China and Russia and various central banks around the world are trying to position for such a move as Triffin's dilemma starts to really take hold and the dollar starts to get its butt kicked, which you say, well, wait a minute, the dollar's doing great. Well, yeah, right. If you believe that, it's benchmarks against other currency. That whole Forex market looks like a crock to me. They're printing dollars. The dollar's not getting stronger. It's simple. So I think we're going to go to a gold-backed currency of some kind. All you have to do is have China or Russia step up and say, hey, by the way, our currency is gold-backed. Who's gonna work with dollars at that point? I don't know. So I think I'm holding gold for that.
Yeah, they may do they may start like a gold-backed trade settlement where each other's bonds are settled in gold or something like that first. But yeah, I think that's the way we're going. Is Russia, China, those countries, they're fed up with the U.S. and the terms of trade and the dollar's exorbitant privilege as the world reserve currency and the petrodollar system. How they work their butts off to produce more goods and services, and the U.S. just prints more dollars, and that's what the type of global trade we have, where the U.S. doesn't print goods, doesn't create more goods. Lots of goods and services in exchange for goods or services. We just send them more dollars. So, yeah, I definitely agree that system is not sustainable. I can't tell you how much longer it has, but I'd be very surprised if it lasts another 5 to 7 years, let alone 10 more years. I'd be extremely surprised based on, what we're hearing from foreign countries and these agreements with currency swaps and bilateral trade agreements and the amount of gold that Russia, China, and India are accumulating now.
Well, the other thing is our current expansion, which is, I kind of laughingly call it expansion because it's not very expansive. To the extent that it has been expanding, it's one of the longest in history now. And expansions die of old age. That's the interesting thing. They're like trees. They reach an age where they just don't expand anymore. And so to the extent that I think it's the sixth longest expansion since 1854. And,
really?
Yeah, and 6 out of 34 measured expansions, and so it's getting long in the tooth. And then the question becomes, okay, so let's say we have a recession. Let's say, can this be a garden variety recession? Do you think we're robust enough and durable enough and not brittle now that we can go through a recession without some really seriously damaging secondary effects? And you and I think that's a rhetorical question, right? You and I both think no, is my guess, right?
Yeah, I mean, the way this money system is designed, it's designed to grow perpetually. It's debt-based fiat currency. It's created out of thin air, fractional reserve banking, things like that. So it's meant to basically be an exponential function. And you know a lot of math. You're a scientist. You know that exponential functions don't survive normally. They can't
Never.
keep going exponential. Yeah.
Never.
So yeah. So it has me very worried. I can't tell you when the exponential function is going to cease to going exponential, but it's definitely scary.
Yeah.
Well,
I think that's right.
Well, I just want to thank you for your time today, Dave. Please tell our listeners where they can get a copy of your work, which website it's on, or how they can get a copy of it if they want to read it.
There's a couple ways. My email's easy to get. I'm in the Department of Chemistry at Cornell. That's enough information for most people to get to me if they want. I have a Twitter feed that's David B. Collum at David B. Collum. And then I have the year in review is first posted at Peak Prosperity, but and then secondarily at Zero Hedge. But I also have a website. It is by no means a glossy website. It's just an archival website where I've just posted everything. All my podcast hours from last year is there, and my interviews at Russia Today and stuff like that. And all my years in review that are still out there online. And that you can find by searching a name we named it. It turns out to get it to the top of every Google search. Dave Goes Rogue. Dave Goes Rogue. And if you type that into Google, a virgin Google web search, you will get that as your top link.
Okay, great. Well, I just want to thank you again for your time, and we discussed a lot of very interesting topics. I think our listeners who want to be more informed and learn about markets, they should definitely check out your 2014 review if they're not familiar with maybe what happened with 2014, and definitely read the 2015 one and maybe keep track of things. Although you said you're not making exact market predictions with the Dow or oil prices or anything like that. So
yeah, I'm not dumb enough to do that. I just stay agnostic. I'd say something will happen, but I don't say when.
Yeah, I think that's pretty smart to do. Although Yeah, so the timing of things is just very difficult. I think in a lot of cases I have the fundamental analysis right on a lot of things, but the timing of things is just extremely difficult to do. I do look at charts and I do look at fundamentals. It's just tough to get everything in unison. And I'm not a Keynesian. I'm not making models trying to trying to predict things off of those. Well, thanks again for your time, Dave. I appreciate it, and Merry Christmas and a Happy New Year to you.
You betcha. You too, Jason.